Hello, I'm Brian Bulakaitis, the National Sales Manager for the Broad Market Channel at Pacific Life. It's our honor to continue in 2020 as a premier sponsor for NAILBA 39. Congratulations to Dan and the team on launching the first ever virtual NAILBA. It's our pleasure to sponsor our next speaker. Todd Nasser is Senior Vice President of Investment Management for Pacific Life. He's a graduate of the Wharton School at the University of Pennsylvania, and he's been with Pacific Life since 1991. Todd will share with you the challenges of investing during the time of a pandemic and what insurance companies are doing to navigate during these challenging times. Here's Todd.
Hi, thanks for that introduction. I'm Todd Nasser. I run the general account at Pacific Life. And I'm here to talk about the investing side of an insurance company through a pandemic or the pandemic or in times of pandemic. Hope this is the only one we really have to invest through for a good long time. But I really want to break it down into sort of four pieces. One, how are life companies doing in the current environment? Then talk a little bit about the progress of not specifically the virus, but how the virus is impacting consumer behaviors in the economy. Then I'll talk a little bit about how insurance companies are reacting to those changes. And then finally, maybe talk a little bit about how insurance products have to adjust to how insurance portfolios are investing, and then maybe I'll give a little advice at the end for what that's worth. So starting with the life insurance industry, you will see a lot of articles about how there are losses throughout the industry. I think that's important to note, but it's not something to particularly be worried about. This is definitely a shock that will hurt profitability, but not solvency, at least not for the strong carriers. And most of the carriers that you would be familiar with are strong enough to make it through an environment like this. A lot of the profitability issues are non-cash items like assumption changes and acquisition cost impairments and things like that that do not affect ongoing operations. And one way that you can see this is just to look to the rating agency reports. Again, every major insurance company has been back to the rating agencies to talk about how business is going, how the investment portfolios are doing, how the assumption changes and acquisition cost issues are rolling through GAAP income. But on a statutory basis, most companies can raise capital if necessary, but also haven't really seen very much impairment to their capital base, their capital ratio, and that's a good thing. You'll see you can go, most insurance companies, most life companies on their websites give you access to the latest rating agency write-ups, or you can go straight to the internet and see how Moody's, S&P, AM Best, Fitch, and others are thinking about life companies. But it's really hasn't been a problem up till now. You will see some deterioration in the investment portfolios. Below investment grade bonds will go up. Sort of reserves for losses in some cases will go up. A natural part of any downturn. For example, I can tell you the Pacific Life portfolio, our below investment grade holdings as a percent of the bond portfolio have gone up a little bit, but still below where most companies would have wanted to be going into the beginning of the downturn. If you see companies where their below investment grade percentages are in double digits, that would be something to ask about, not something to immediately get alarmed about, but a conversation that you would want to have, or see what the rating agencies think about the investment portfolios. We have very good conversations with them, very open, very frank, and I think they like what they hear, and that's reflected in our ratings. And again, most major life codes, you would see very, very similar reactions. So are things going to get better, or are things going to get worse? I think we're all expecting both. Certainly the progress of the disease, and we're investment folks, not virologists or epidemiologists, but watching the trends, it looks like for the virus, for the quarantine rules, for the economy, things are going to tend to get a little worse for a while and then start to get better. We like the news that we hear on the vaccines. That's a very positive signal for us that things are going to start to get better, but also to see that treatments are better, people are taking more care of themselves and just getting ready to go and re-enter the economy. And that should be good for, again, most life companies and the portfolios for most life companies. You're still going to see hotspots. Globally, you're going to see flare-ups within the US. You're going to see different geographies suffer at different times. But in general, there is a light at the end of the tunnel as, again, treatments improve, people start to get vaccinated, people learn how to be safe in public. They'll start to travel again. We will have sporting events at some time again. Theme parks will open and we'll slowly get back to normal. How slow that is and how much cash these companies have will be different by industry, by geography, by sector, but it's certainly going to eventually start to get better. We're heading into a holiday season like no other. We are going to see people travel less, people go to malls less, more online purchases, more entertainment through our computers and TVs and things like that. That's not necessarily something that's bad. It's just something we're all going to have to get used to. And when we look to invest, we're going to have to understand how things are going to change. The real question, and it seems far off, but the real question we're all asking ourselves is, how is next holiday season going to be? How is the next summer's travel season going to be? And when we have to invest for 5, 10, 30 years, these are the questions we always ask ourselves. Tougher to answer now, but again, we do see some signals that are troubling, continued losses of jobs, but we do like the support we're getting from central banks. We do like the idea that the governments are trying to help with stimulus packages, all good, but eventually we will hit brighter days. Speaking of stimulus, we'll have a new administration in the White House. Early on, it does look like, at least for the economic team, Biden's putting together a dream team. Janet Yellen, who might end up at Treasury, is a name that we're all familiar with, an extraordinarily bright individual, and one who knows Jay Powell over at the Federal Reserve very well. They worked together for years and years. And it should be the type of team approach that we saw in the global financial crisis, where the Federal Reserve, the Treasury, and global central banks and governments all tried to work together. I think there are certainly the early signs of the type of approach that the Biden administration is taking is a positive one. We'll see how stimulus talks play out. But again, early on, we do like the signs that we see. In terms of the Federal Reserve, they're both the the best and the worst. They are doing their best to try to keep the economy buoyant, keep people employed, make sure that if there's a company with a sound business model, that they're not going to go bankrupt just because of lack of liquidity. We see them standing behind corporate bonds and other investments, trying to lift asset prices, get people investing, get people to go out and spend money. Part of the way that central banks traditionally get people to spend money is by keeping interest rates low. If interest rates low, people are less likely to save for their retirement, not necessarily something that's good for policy owners or insurance companies, but something that we have to be realistic is going to be around for a while. The Fed has been very clear that they're trying to keep interest rates low for 2, 3, 4 years. And whether low means zero or just historically low, we'll have to see how things play out. We'll have to see how the economy plays through the pandemic. We'll have to see the effect that low interest rates do have on savings rates, spending patterns, employment patterns. But again, at least we don't have to worry about solvency. Companies that need liquidity are finding liquidity, and that's a good thing. So our credit losses aren't going to be zero, but they're going to be a lot less than they would be if the central banks weren't there making sure that the markets are as liquid as possible. Another side effect that we've all seen is the equity markets continue to go forever up. The Dow Jones, the S&P, a lot of our 401ks are doing really well as equity markets push up, as bond prices push up. Unfortunately, bond prices pushing up means that investment rates for life companies are pushing down. So let's talk a little bit about how life companies are evolving what they do for the new environment. So let's just say the new environment is one of very high liquidity, strong equity markets, low interest rates, and a lot of guarantees on the books that we have to make good on. One thing that we always do, all life companies are going to be very aware of, is what we call asset liability matching. We know the products and the guarantees that we have for our policy owners. And what we try to do is invest in such a way that we have guaranteed interest rates for as much of the guaranteed product features that we can have. So if we wrote a life policy with a 4% guarantee 20 years ago, we put on as long a high coupon interest rate as we can. As those bonds start to mature, we're investing at lower rates. And that's why you're, again, going to see guarantees come down, which we'll talk about more when we talk about life products. So most life companies have portfolios that the bonds and the guaranteed interest rates we earn are matched to the products and the guaranteed features that we need to pay. If you look at most large life companies, you'll see the same basic mix of what they do. 70% of that will be corporate bonds, maybe about 20% will be commercial mortgage loans, and then 10% between cash and others. And the other investments could be more speculative, could be more things like equity, infrastructure investments, timber investments, agriculture investments, things like that. Not necessarily higher risk, but given that they take a little more know-how, insurance companies can clip a little higher income off of those to help keep their portfolios high return in low interest rate environment. We're seeing our bond portfolio hold up. Like I said, we have some credit issues, but luckily not a whole lot. The commercial mortgage loan portfolio is holding up. It will depend on, as we spoke before, to see how the virus goes, to see when people want to get back into hotels, business travel, go back to football games, movie theaters, bowling alleys, and start to congregate. And, as goes the business traveler, so will go a lot of the hotel loans and office loans and things like that we have on our books. In terms of the other, again, just like you're seeing with most other asset decisions, with interest rates low and equities moving up, you're going to see a trend into more equity and equity-like investing, taking a little more risk on the margin. Again, watching all the metrics, how what the ratings on your bond portfolio are doing. So somebody who went into the a downturn with a very clean, very high, highly rated portfolio are going to have a little more room to do more speculative investing. Others who are having more trouble on their portfolio are going to lag. And again, the value of sticking with a highly rated carrier when you buy a policy. Certainly, everybody does their due diligence on the insurance industry, and looking at the portfolio is going to be a big part of that. But you will see more equity investing, just because if you have to buy equities when bonds are 6 to 8%, you want to do some. When bonds are 1-2%, you're just going to be pushed into doing more. Again, each company knowing how much equity risk they want to take on, how much capital they have to absorb the volatility that you'll see. But with a supportive Fed, it just makes sense for people to be more creative in putting together their portfolios. How will products react to the changes in the market? Well, again, like most life companies, there's a very tight relationship between how you invest in the products that you sell in both directions. We in the investment side sit down with our product people every day to know what features make more and less sense, and how we should think about investing given the products that the consumer wants to purchase. So if a retiree wants more guarantees, that's going to push us one way. If the portfolio is seeing opportunities somewhere else, it's going to push us another way. Guarantees are easier when interest rates are high and the credit outlook is solid. So given the uncertainty in how the future is going to play out and the level of interest rates, I would guess that there will be a continued move from guaranteed to non-guaranteed products. Certainly, you see policy owners taking on more of the risk as guarantees become less attractive. And again, guarantees aren't becoming less attractive because we don't want to fill a need. It's just with the level of interest rates, with the uncertainty in very long-term investing, we're going to make sure that we can give the best guarantees that we can support. And with low interest rates, it's just harder and harder to support very, very strong guarantees. So we're seeing customers move to indexed products. We're seeing rejuvenation in variable products, and that's good. Every retiree should have a balance of risks. Every insurer should have a balance of investment products that they lean on, and therefore the products that we sell are going to hopefully be balanced between life insurance and annuities, between long-term guarantees and short-term guarantees, between fixed rate products, declared rate products, index products, and variable products. And again, knowing your customer, knowing what needs they have and matching them to the right product is always going to be key. Products in general are probably going to get more complex just because in a time where guarantees are hard to come by, we're going to figure out what the best guarantee we can engineer is, but sometimes some of that engineering leads to complexity. We're here to help you through that. Our marketing people are terrific in explaining both why very simple guarantees are difficult in these markets and why customers should be comfortable with the products that we own. Nobody likes it when illustrations are 50 pages long. There's a lot of regulation to make sure we tell the truth, the whole truth, and nothing but the truth. It's something that we pride ourselves. Sellers work with the producers, and then producers have everything they can to speak to policy owners. With the markets where they are, we're just going to try to do the best we can to put the menu of products in front of you with the best, cleanest, simplest features we can. But again, we're working toward investing through headwinds that we tried to discuss. There's going to be more equity risk within insurers when the equity markets are good. That's going to be a good thing. Again, each insurer knows how much equity risk they have, what hedging that they need to do, both interest rate hedging and equity hedging. And again, we have very open conversations with our internal risk people, with rating agencies, and that has helped us guide ourselves to know how much risk we should be taking relative to other life companies, relative to other financial institutions, and again, relative to highly rated companies. We do want to make sure that we're there to support our guarantees in the future. So we'll look to raise capital when we think it makes sense, because again, nothing's better for a rainy day than having enough capital on the balance sheet to make it through the volatility. So with that, maybe a little advice would say, again, stick with the higher rated carriers, know the carrier, know what their principles are, know who they want to be, where they're going in the future. The insurance industry always does a great job of explaining themselves. Lots of information on our websites, in our annual report. You can see in almost any annual report from a life company what their investments look like, how much guarantees they have, what their financial performance is, how highly capitalized they are, what the rating agencies think. And again, an educated consumer is our best customer. We try to give our customers the best overall package. And again, the more you look into what companies you want to do business with, the better you're going to do in the long run. Sometimes the easiest thing to do is just look at numbers on a page and look at the highest number and say, I want that one. But sometimes that comes with a lot of baggage that you might not want. So looking for a company that's been here, been tested through various cycles and done well and still has plenty of capital and high ratings is going to be as important as ever. Keep up to date. It's a very fluid market. Lots of risks come and go. A communicative life company is a good partner for you. Know that you can ask questions and actively ask questions. policy owners should be asking questions of producers. Producers should be asking questions of wholesalers. When you can get information from senior executives or investment people, watch videos like this. NAILBA does a great job of getting people who know what's going on within the industry out there. But any sort of magazine articles, interviews, webcasts, this is the time to know what's going on within insurance companies as much as any. Again, a lot of companies, there's going to be a lot of good news. Other companies are going to have more volatile times, and knowing who you're doing business with, again, is as important as ever. And then maybe the last piece of advice would be open-minded, but remain disciplined. Open-minded means think about other things. If there are policy owners who've generally looked toward fixed rate products, trying to understand if index products might work for them, or how much a variable product could fit in a portfolio. Again, there's going to be different needs for different people at different points in their life, whether they're looking to wealth transfer or retirement or just protection. A company like Pacific Life, most highly rated companies are going to have a suite of products for any need. And the more flexible that you are working with the companies, the more likely it is you're going to find a match for the amount of risk that a policy owner wants to take on, and a product and a company and an investment portfolio that makes sense for them. So thank you for your time. Thank you to NAILBA. We, again, always look forward to doing our best to communicating with the industry at large, let producers know what's going on, because as long as the news is good, a good open conversation is helpful for everyone. Thank you.